Good morning, everybody. This is Dee Reinhardt with Illinois WorkNet. Welcome to our presentation on how to finance a startup business. Today, we are going to be talking about the steps and the tools needed to finance your new business, and we're going to be doing that with a guest speaker this morning. We are recording this webinar, so you will be able to find it on our YouTube channel for future reference. Please download the handout in the lower left-hand corner. It will be attached to the news item on Illinois WorkNet if you are not able to watch this right now and are watching our recording. One of the things that we need to talk about is a business plan. To make sure that you have everything in place so that you can finance your business properly, you will probably need a business plan. We'll have a couple of resources at the end of our presentation that you can access to make sure that you have a good business plan in place. But the other things that you need to understand are some of the other essentials that are listed on the right-hand side. And our webinar last week focused on business registration. This week we're going to be talking about finance, lending, and funding. So let's move on to our guest speaker, Harriet Parker. She is the manager at the Small Business Development Center for Waubonsee Community College. That is in Kane County, Illinois, which is one of the collar counties of Chicago. And Harriet has been a valuable resource at the center for over 20 years. Harriet, why don't you tell everybody just a little bit more about what you can do for small businesses at Waubonsee?
Sure. Thanks a lot, Dee. I manage the Small Business Development Center at Waubonsee Community College, which is located in downtown Aurora. The Small Business Development Center, or SBDC as we use the acronym, is a grant-funded program, and we provide assistance at no cost to entrepreneurs and local business owners. So we offer a variety of workshop-style classes as well as one-on-one advisory services to help people who are starting or running a small business to make their endeavor more successful.
Great. So now let's get going with our presentation this morning. What we're going to talk about today is identifying financing options for a business, and we're going to cover those three areas that are on your screen right there. We're going to define some business costs for you, and we're going to talk a little bit more about understanding financial statements. So as we go through this, if you have any questions that relate to these items, we're more than happy to answer them for you. And let's start rolling with this presentation. So Harriet, talk to me about equity financing.
Okay, sure. Thanks, Dee. So when you are looking for financing for your business, there are a number of different options that you might be pursuing. Some of those options depend on the situation that you're in, and we'll start with talking about equity financing. So equity financing basically is funding that's provided in exchange for some part of ownership in your business, most often. The most common types of equity financing, of course, the first two, you yourself, when you invest money into your business, you take an equity position equal to the value of what you have invested in that business. You may also have friends and family who want to take an investment in your business. Now, if they're giving you money or loaning you money for that business, that would not be considered equity financing. But if they are going to take a part ownership in that business, then that's another option. The other two primary types of equity financing are angel investments and venture capitalists. So I want to talk a little bit about that. First of all, if as an owner you are investing money in your business, which is the most common form of equity financing, you want to make sure that you keep track of that and that you account for your investment in the business so that you receive credit for that investment. Many business owners open up their business and they put money into it, but they don't really keep a set of books to keep track of that. So later on, when they want to possibly go get ongoing financing from a lender, for example, there's no record that they have put that money into their business. So very important if you're investing money in your own business that you record it and track it in some way, whether it's through your accountant recording that or using QuickBooks or some other bookkeeping software just to show a record of that. If you are going to be taking equity funding from friends and family, you are most likely going to want to consult with an attorney to make sure that you structure that investment properly. That may not seem important in the beginning of your business, but it is going to be important later on. If you ever need additional funding, you're going to want to have that structured properly so that those friends and family members can recoup their investment or be in the position that they want to be in that business with their equity ownership. Also, obviously equity funding almost always involves giving up a percentage of ownership of your business. So you want to pay attention to ideally you want to retain controlling ownership in your business, although that's not always the case. If you are, for example, a tech company and you've got a lot of equity investment, you may be retaining a minority ownership position and still have be in a good situation. And then lastly, and probably most importantly, because I get a lot of questions from people that are opening up a restaurant or a coffee shop or a retail business, can they get outside investment? And unless you have, again, friends or family who are really passionate about what you're doing and want to be in an ownership position, it's very uncommon for a venture capital or even capitalist or even an angel investor to invest in a startup or something that we would call a lifestyle business, which would be any business that, while it may be profitable, it's not a high growth situation. So typically you're going to find that investment money, if it's coming in the shape of equity, from yourself and friends and family. Now I want to move on to debt financing. Debt financing is more common in business financing, and it's basically defined as funds being provided by a bank or other lending entity that will be paid back by the borrower over some period of time. Usually there is interest involved, although not always. And most of the time the funder is going to have the ability or the right to enforce your repayment of that loan. So they're typically going to be taking some type of collateral so that if you renege on that loan or don't pay that loan back, that you will be, they have the right to liquidate or take possession of assets that you have pledged as collateral. So I want to talk a little bit about the types of loans. First of all, SBA loans. There's a lot of people are aware of SBA loans, but they don't really understand exactly how they work. With an SBA loan, the lender is going to be backed by the SBA for that loan. So in order to get an SBA loan, you're going to go first to your lender. The lender is going to probably recommend that they do SBA financing, and then they are going to work with you to to structure that loan with the SBA. There are fees associated with SBA financing that are not insignificant, so you will expect to be paying some fees if you're obtaining an SBA loan. There are also some restrictions on SBA loans as to the types of businesses that can be financed. So an SBA loan will not be eligible for real estate investment situations, for example. Talking about a term loan is a loan that where you're given a certain amount of money up front and then you pay that money back over a period of time. So term loans are common in situations if you're purchasing equipment or property or other assets. Those assets are used as collateral or partial collateral, and then you pay the loan back over the term. So equipment loans, for example, can be in the 5 to 7 year range. Property loans are typically more in the 20 to 30 year range, and that's how a term loan works. Yes.
On these loans, do individuals need to take these out in their business name?
Most commonly, yes. It used to be that many people financed their business using a home equity line of credit. So they would take a line of credit loan on their house and then use that money for their business. We don't really see that a lot anymore just because of the devaluation of property. So yes, typically that loan is issued in the name of the business. However, it's backed by personal collateral.
All right.
And I'll talk a little bit more about that on my next slide.
Okay.
Now, lines of credit is a situation where you are given the ability to borrow a certain amount of money. So let's say you get a line of credit for $50,000. You don't have to take all $50,000 up front and then pay it back. It's available for your use. So let's say that you're going to be manufacturing a product and you need $10,000 up front to pay the manufacturer. You can pull $10,000 out of that line of credit, and then you pay that portion of the loan back with interest. Depending how the line of credit is structured, you may be able to pay it back with just with interest only. But the best practice with a line of credit is you want to borrow, pay it back, so that the bank sees that you're not using it like a term loan. And then lastly, I want to talk a little bit about alternative or microloans. Microloans, yes, go ahead.
Before you move there, revolving loans are typically like credit cards that people use for personal use, or is there
correct,
a revolving loan for business?
Well, there are some revolving loan funds out there, and again, they work similar to and they're different loan funds and they're structured differently. I don't see in my area, I don't see them used all that frequently. But basically, it's similar to a loan where you're being given a certain amount of money and you're paying back over time.
Sure. Okay.
Now, microloan funds, again, that might be a good example of kind of how a revolving loan works, is micro lenders are private nonprofit organizations that make small dollar loans to businesses that typically don't have the qualification criteria to obtain a bank loan. So they may have poor credit or insufficient collateral or some other, higher risk situation that is going to cause the bank to deny them. Microloans are a little bit more accessible, easier to get, although there are still qualification criteria, typically the same criteria that a lender uses, and again, I'm going to talk about that on my next slide. But they're easier to get. The downside is that they're typically a smaller dollar loan, and they are going to be a higher interest rate. And I am going to talk about predatory lenders a little bit later. The microloan organizations that I have listed here are reputable. They charge higher interest rates, but they're manageably higher interest rates. So those are great ways if you're just starting a business and you can't qualify for a conventional loan to get some money to get your business up and running. Axion is the micro lender who we work with the most, and I believe that they also do the micro loan program for the Small Business Administration.
Okay, great.
Okay, so let's talk a little bit about the qualifying criteria in order to obtain debt financing. And we hear a lot about, the banks talk about the 5 C's of credit. So what does the bank look at when they're making a decision about whether or not to, to to make a loan to you? So the first one is credit, and the rest are not in any particular order, but credit is, because the bank is going to start by looking at your credit score and your credit history. So there are 3 credit reporting agencies, Equifax, Experian, and I'm drawing a blank on the third one, but they have a way of rating your credit history and a scoring mechanism. So typically a lender is going to want to see a credit score at least in the 700s to make a conventional loan. Now, this is why it's really important, if you're considering talking about to a lender about funding, that you are managing and maintaining good credit. So your credit score is going to go down if you have outstanding debt that you're not making payments on a timely basis. It could be damaged by opening up too many lines of credit, so that it happens if people have too many open credit cards, because credit is also determined based on how much you might be able to borrow, not necessarily just what you have currently outstanding in debt. So really important to manage your credit. The next one is collateral. So collateral is assets that are pledged that can be liquidated by the lender if you fail to honor the repayment conditions of the loan. So a lot of people that are starting a business are surprised to hear that they have to pledge personal assets when they're getting a business loan. But the reason for that is that either the business does not have assets of its own, or they don't have sufficient assets, so the lender needs something else as collateral. If your business has been established and running for a while and you have assets in that business, you may be able to just use those assets to collateralize a loan. But even, oftentimes assets, hard assets like equipment or furniture and fixtures, have such a small liquidation value that there oftentimes is additional collateral needed in order to support that loan.
Okay.
The next C is cash flow. Some people call it capacity. And that is existing sources of income that are going to be used to make the loan payment, as well as cover your personal living expenses. So when you start a business, the lender is going to assume that your business is not going to generate positive cash flow or profits for at least a little while. On average, statistically, a business takes up to 3 years or more to reach consistent profitability. So the lender wants to see that you have that capital to be able to cover those costs in the early stage of your business, as well as cover your personal living expenses, because it's also very likely that you may not be able to take a regular paycheck out of that business. So they're looking at other sources of income. You could have a part-time job. You could have a spouse who's working and bringing in income. Sometimes people will have an inheritance or some other form of income that's going to give the bank a better sense of security that you're going to be able to make those loan payments and keep things going. The fourth one has to do with conditions. So as we all saw during the most recent recession, credit became extremely tight. It still really is that way because businesses were closing and the economy was struggling, and so the risk for that business went up, and the willingness of the lender to make that loan went down. So that's another thing that the bank is going to be taking into consideration. And then the last thing is character. And character is going to be presented to the lender through your business plan. And it is your expertise or experience in the type of business that you are opening. So to give you a good example, let's take a restaurant. Restaurants are tough to get financing for. You may have a favorite recipe or love to cook, and all your friends are telling you what a great cook you are, and so you think you should open a restaurant, but you don't have any operational experience. The bank is going to be concerned about that. So those are the things that the lender is keeping an eye on as they evaluate whether or not you can obtain that loan. And they're also going to be, of course, looking at your tax returns and other financial history to determine how financially sound that you are.
Great.
Okay.
Great. Thanks.
All right. So let's talk a little bit about the required documents when you are getting ready to request a loan. So typically when you go into talk to a lender to request a loan, you want to be prepared. That doesn't necessarily guarantee that you're going to get that loan, but it's certainly going to give the lender a better impression, and they're going to take you more seriously if you come in prepared. So what a lender is going to, at a minimum, ask for is your business plan, including 3 years of detailed financial forecasts. So one of the most common things that I see that cause a problem with the lender is when the business plan, the projections for the business plan say revenue for year 1, year 2, year 3, but no monthly detail on how that's going to develop. Also, tax returns, your personal tax returns for 3 years, 3 years of financial statements if you're an existing business, your articles of incorporation, and any legal documents related to the business. So if you have contracts, a lease agreement, a franchise agreement, any kind of legal contract related to your business, the bank is going to want to see it. Also a personal financial statement, which is a statement of assets and liabilities. So cash in the bank, outstanding loans that you may have, and personally, they want to see personally how your financials look. And then lastly, they are going to most likely pull a credit report on you. There is a link on this slide for the SBA website that has a business loan checklist on it. So if you want maybe a little more comprehensive list of what documents a lender might require, you can visit the SBA website and pull down that business loan checklist.
We also have the live links in a pod in our closing screens, so you can get that link when we do our final session here.
Okay, great. Thank you, Dee. Okay, I want to talk about grants. This is a very common question that we get at the Small Business Development Center is, where can I get a grant to fund my startup business? And unfortunately, the answer we have to give you is you can't. Grant funds are almost never available to fund the general expenses of a startup business. And people never believe us when we tell them that. So there is, again, here a link to a page on the SBA website that explains a little bit more about government grants and what exists and some of the myths surrounding grants for small business. So I want to talk briefly about some grant programs that do exist. There are federal research grant programs such as the SBIR or STTR grants, which relate to companies that are developing new technology or new systems and are in the research stage of that. Typically, someone who is going to be eligible for one of those grants will be working with an educational institution, a university or similar, on that type of a project. There also are local government grants such as ETIP funds, which are state grant funds related to training. So if you have let's say a manufacturing business and you need to be training your employees on welding or supervisory skills or something like that, you can often get some grant assistance that way. Organizations like Waubonsee Community College provide business training and can help you obtain that grant money if it's available. Small Business Improvement Fund is a program that uses TIF revenues to help owners of commercial or industrial properties repair or remodel their facilities. That's a little bit complicated, but something that your economic development organization can assist you in understanding whether or not you qualify for that if you think it's applicable to you. Again, typically for an established business. And occasionally you will find there are city grants, local grants for facade improvement or special subsidy programs. For example, if you're in a lower mod income area, there may be some redevelopment funds available. So check with your local government, your economic development organization or chamber of commerce to see if they're aware of any local programs. Typically also the small business development centers are aware of some of those local programs, so you might want to visit the SBDC in your area to see if they're aware of anything like that. And then lastly, you will see periodically some grant contests. Chase Bank ran one recently, and they're legitimate. The challenge is that you have to put some work into entering that contest, and then you have to rally the votes for yourself through that contest, and it can be sometimes a distraction to a business to be focusing a lot of time and attention on these contests where your odds of winning grant money may be on the low side. Okay, and then lastly, just a few other financing options. Crowdfunding is something that has been a very popular and in the news topic lately. Some crowdfunding platforms, examples, ones that you've probably heard of, are Kickstarter and Indiegogo. There are many other ones. And just a brief explanation of crowdfunding to help you understand what it is. Basically, the crowdfunding platform, so Kickstarter, for example, sets up a portal for you to operate that funding campaign, and they handle the collection and the transfer of monies that are received. You are responsible for developing your social network and creating any promotional materials or marketing to your network to get your followers to back you financially through a crowdfunding campaign. Currently, the Securities and Exchange Commission does not allow funders to take an equity position, although that is being talked about in the House and the Senate now, and there are bills to try to change that. The most common crowdfunding model is where you provide your funders like a pre-release version of your product or naming rights or some other like prize or giveaway in exchange for them supporting your operation. When you do a crowdfunding campaign, you have to set the level of funding that you want to achieve, and then if you don't achieve that level, the money goes back to all the people who pledged funds to you. So you want to set a realistic, goal for your funding campaign so that you can be successful with that. And then lastly is I want to talk briefly about predatory lenders. With the tightening of the credit market that has happened in the last few years, we're seeing an influx of lenders who are charging exorbitant interest rates that are often not easy to decipher or determine as you're looking at that loan opportunity. So if you see an opportunity that is too good to be true, you should pay attention to that and maybe look a little more closely into the conditions of that loan. But any type of loan that you're going to be obtaining, you want to make sure that you do your homework, that you review all that paperwork, that you totally understand the terms and the conditions of that loan. If you want a little bit more information about how to evaluate a loan to see if it is predatory, Axion has a document on their website that gives you a way to calculate interest rates that are stated so you can determine what your actual repayment amount is going to be. So that may be helpful when if you're looking at an opportunity, a loan opportunity, and you're not sure if it's something that is legitimate or not.
Great. Now, with banks too, is there a way to check to see what banks, is there a, other than Axion, is there a place to find banks that are properly approved by?
That I know of, there really isn't. So there's, a lot of this is fairly new, so I don't know if, anywhere that there is a list that says avoid this lender. I'm guessing that's probably because technically, I guess there's nothing illegal about what they're doing. It's just that you can get yourself into a situation where your repayment terms are going to put you out of business, basically.
Sure. Sure. Thank you, Harriet.
Yep, you're welcome. Okay, so I want to talk a little bit about business cost terminology. So when you are getting ready to go talk to a lender about a loan, there's some, and you're putting your numbers together, there's some things that the bank is going to want to see in your numbers. So I want to briefly describe what some of those different numbers are. These are things that the SBDC can help you with putting those financial projections together, can help you with kind of understanding how to break your costs out, but just knowing the terminology can be helpful. So the first one here is your project cost. So if you're starting a business, what is that going to cost you in startup costs to get that business up off the ground and doors open, either actually or virtually, for business? So startup costs are going to include all the one-time expenditures that you need to open your business. It could be a rent deposit, it could be inventory investment, it could be furniture and equipment, it could be build out, or refurbishing the space to get it to what you need it to be, your first insurance payment, any legal fees related to opening your business. So all of those are considered startup costs. Also, another term is working capital, which working capital can also go into your startup costs, and that is cash on hand that you have available to pay your ongoing business expenses. So when you start your business and you put $5,000 or $10,000 into your business, you've essentially said, here's my working capital, here's the money that I have put in the bank to pay my ongoing expenses until my business is generating profits that will cover those costs. The next one is cost of goods sold. There's other terms for that, direct costs, variable costs. Those are expenses related to the generation of sale of products or services. So examples would be your food costs in a restaurant, any contract or hourly labor that you use for generating sales. So if you're a caterer, for example, and you contract with someone to just run the parties that you cover, but you don't pay them for any other time, that might be considered a cost of goods sold. Inventory for a retail store or manufacturing operation, all of these are cost of goods sold. Once you deduct your cost of goods sold from your revenue, and we'll talk about this a little bit more in the financial statements, then that's going to tell you what your gross profit is. And out of that profit, then you're going to be paying your fixed costs or overhead or indirect or general and administrative costs. And these are the costs that typically don't change. So things like your rent, marketing expenses, utilities, your administrative payroll, so paying yourself, paying a receptionist or somebody who's working a set number of hours every week. These are costs that that don't go up and down a lot. And they're not tied directly to the generation of a sale. And then gross profit I mentioned, which is the money that you make from a sale after you've paid the cost of goods sold or the direct costs. And then net profit or loss is the amount of money that you make in your business after all of your expenses are paid. So these are all things that are going to show up on your profit and loss statement, which we'll talk about in a minute, and things that the bank is going to want to see and know about in either your projections or your business financials.
Harriet, we have a question about licensing and franchising fee. Those are all considered in the startup costs, correct?
Well, the initial franchising fee or license is a startup cost, but then if we take franchise, for example, then there's probably going to be an ongoing fee for franchise. So that could end up in both of those categories.
Okay, thank you.
You're welcome. Okay. Now I want to talk a little bit about financial statements, which tends to scare people a little bit sometimes. So I want to start that out with really 3 things that are important about money and numbers in your business. And the first thing is that you do not need to have a degree in finance or be a CPA or even really be a whiz at math or have a good financial education to understand your financial statements. So financial statements are a really important part of your business, and you can understand them. So you don't maybe not know all the nuances, and you rely on your accountant for that, but the SBDC can help you understand your financial statements at least enough for you to get the most important data out of them. Your business is going to be stronger and have a better chance of surviving if you make decisions based on your financial data as opposed to kind of what your gut tells you about the business. And last thing is we really encourage business owners to use some type of accounting software and garbage in, garbage out. So if you aren't keeping accurate accounting of your business transactions, then the data that you're going to get out of that system is not going to be reliable as far as helping you manage or grow your business. So keeping track of your numbers and running those reports is an important thing, and you don't need to be scared of it. We see a lot of business owners who just don't think they can understand their financial statements, and that's not true, and we can help just about anybody get a basic understanding of those numbers. So really briefly, I'm going to go through the financial statements. I'm not going to spend too much time on these because there's really a lot there. I just want to give you a quick look at them. You can look more in the presentation after we're done here. And by all means, consider using the Small Business Development Center to help you understand these better. So there are 3 major financial statements in your business: a balance sheet, a profit and loss or income statement, and a cash flow statement. The balance sheet is going to tell you the state of your business at a particular point in time. So it's going to explain assets and liabilities and net worth. So assets are anything that your business owns. That could be cash in the bank. It could be accounts receivable or money that's owed to you by another business. It could be fixed assets like your equipment, your furniture, your fixtures, buildings, that type of thing. And then liabilities are all the things you owe. So that could be like, payments to vendors that you just got bills for. It could be debt, bank debt, loans that have to be paid off. And that fixed assets, that's incorrect. That should not be there. And then the difference between your assets and your liabilities is the net worth in your business. So if you own more than you owe, you're going to have a positive net worth. If you owe more than you own, you're going to have a negative net worth. That retained earnings is the accumulated profits or losses of your business over the time that your business has been in existence. That's a number that the lenders are going to look at. So if you lost money year over year in your business, you're building up negative retained earnings on your balance sheet. The bank is going to look at that, and they're going to be concerned if you have, a substantial negative retained earnings number. Okay, let's talk about the income statement quickly. So the income statement shows your sales or revenue. From that, we subtract cost of goods sold, which we talked about, which would be any expenses directly related to those sales, like inventory. Your gross profit is the money you make after deducting cost of goods sold. And then you're paying your fixed operating expenses, so your rent and your utilities and your own salary. And then from that, then we're deducting those expenses to determine what our net profit is. So we want to show a profitable business. Oftentimes your accountant is going to try to get you to show a loss so that you don't have to pay taxes. But you don't want to pay a lot of them, but it's a good thing to pay taxes because it shows that you have a profitable and a thriving business. And if you ever need financing to grow that business, you're going to have a much better chance of obtaining that financing if you're showing that you have profits in your business. Okay, and then percentages, you'll see some percentages along the right side. Those percentages are used to benchmark and compare your performance both to prior periods and also to other businesses in your industry where you can be benchmarking to see how you compare to your peers. And then the last one is the cash flow statement. So the cash flow statement is showing you all money in and out of your business because not every transaction shows up on your profit and loss statement and not every transaction shows up on your balance sheet. A couple things that you can use your cash flow statement for is planning for seasonality. So if you need to, let's say you're an ice cream shop and you need to make the bulk of your revenue over the summer and then you're going to lose money in the other months that you're open, we want to use that cash flow statement to show that we have sufficient cash reserves to pay those bills. And it is possible for a business to be profitable but still fail because they don't manage their cash well. So if you're doing a job for a client and it requires you to expend some money before the client pays you, if you don't have the cash reserves for that, then you're going to have trouble taking those jobs.
And how often do you recommend checking each of these statements?
You should be running your financial statements once a month, at a minimum. And again, if you're not sure what they mean or what to do with that information, you can talk to someone at the SBDC or ask your accountant or another financial advisor to help look for trends or red flags or other things that might be important to the management of the business.
Great, great.
Okay, so I know we went through that pretty quickly, and obviously there's a lot to absorb in that information. So what do we do next? So definitely I recommend that you seek out some of the mentors that are available to help you with your business. Small Business Development Center, obviously we talked about. SCORE is another organization that provides free assistance to entrepreneurs and small business owners. And anybody, on your business service team, or if you have mentors or peers that can help you. Just be careful that, sometimes friends and family will not give you enough critical advice to be helpful. So reach out to somebody who's objective and not connected to you in some way that's going to be giving you complete and objective advice. So through SBDC, SCORE, the services are free, and for the most part, all of the advisors have business experience. Also, talk to other business owners. It's really helpful. When we hold our workshops and classes, we encourage people to attend those as well as our one-on-one assistance because they're going to hear from other business owners about some of the challenges they face or some of the questions they have, and that will be helpful to you in applying some of that information to your business. So talk to business owners, take classes. There's some links on here for where you can find some of that assistance. And also, definitely we would strongly encourage you to develop a business plan. There's a lot of hype about business plans being overrated or not important. They are important. You may not need a 60-page business plan with charts and graphs, but you do want a complete plan with a detailed financial forecast to make sure that you have thoroughly evaluated your concept to see if it's going to work out or not, and to make sure that you're not missing any costs or omitting anything. The next one's really important. Don't rush. Many people, when they want to start a business, they're in a hurry to get going. But it's really important that you take your time, that you do your planning, that you analyze all the pieces of this, and that you go through all these steps so that when you do go and launch the business, you're as prepared as possible. And if you seem to be running into roadblocks, listen to those roadblocks. It could be that this just isn't the right time, or you don't have everything that you need to have. So just take your time and wait for the right time. Don't sign contracts, especially your lease, until you're certain about your financing. And then even if after you do all this work and you end up not starting your business, don't let that discourage you, because I see so many entrepreneurs that, if they have it in their blood to be a small business owner, that first experience is just going to give them a heads up or a leg up when they go to do their next endeavor. So don't be afraid to let the planning process talk you out of starting a business, but you're going to be able to use all that work that you did when the time is right and you're ready to move forward.
Great, 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 great.
So thank you, Dee, very much, and I'll answer any questions.
I think we've answered most of them during the course of the presentation. So what I would like to do is thank Harriet for her time, for sharing her knowledge and information with us about how to finance a small business. You can find Harriet at the Small Business Development Center at Waubonsee Community College. She is at the downtown campus in Aurora, and she has a wealth of knowledge on all forms and fashions of starting your small business. So thank you so much for joining us today, Harriet.
You're welcome.
What we would like for everyone to do is to fill out these poll questions for us if you want to take a couple of minutes. And we do have all of the links that we discussed right here. So if you want to take a look at these links and click on them so that you have them on your computer for future reference, you can click each of them and browse to them. They will take you to a different page. So make sure that you fill out your poll questions first and then go. If you did not have a chance to download the handout, it is in the file pod. You can see everything that we talked about and then watch it while you listen to the recording if you have any questions after the presentation is over today. So we'll answer any last-minute questions. If you do want to type them into the Q&A pod, we We will be here for just a few moments to answer your questions. I want to thank everybody for joining us today and have a great rest of your day. I am going to end the recording right now.